Shares of DocuSign are plummeting despite fourth quarter results overall coming in above expectations. Investors are looking for improved margins following staff reductions last month. Wells Fargo Securities Managing Director Michael Turrin joins us now. Michael, the issue here seems to be, at least in part, the billings, right? Which sort of is a little bit forward-looking in the first quarter billings forecast. What is going on at DocuSign? It just seems to be struggling to right the ship here.
Yeah. First, thanks for having me on. I think what DocuSign is struggling with is what a number of companies across software are struggling with, which is you captured a lot of growth in a quicker period than was expected during the pandemic. Obviously, there was a critical need for DocuSign a couple of years ago that led revenues up to $2.5 billion. And a lot of companies weren't quite geared appropriately for what's next after that. I mean, this is a company that had 4,000 employees. Before the pandemic, that number effectively doubled to 8,000. And you're seeing just a recalibration period happening. So it just feels like this has been consistent across a number of software companies. It's more pronounced in companies like DocuSign because of the acceleration that happened. And they're just attempting to get back to more stable footing. And you're seeing a lot of changes, which are leading to some frustration from investors just alongside that.
And Michael, part of the changes are management changes. You've got a CFO transition there, a restructuring. There were layoffs announced in February. So how long will these sort of changes take in order for DocuSign to get its footing back?
Yeah, I mean, usually it's around 9 months is the general software playbook on this. You have to think about when someone comes in, they have to learn and observe what's happening, figure out where they want to make change, and then generally bring on a new team to help facilitate that change. With DocuSign, you saw a new CEO come on board in September. You've since seen a new COO and president of the company come on board in January. And I think the wild card that investors weren't necessarily expecting here was CFO transition also announced last night. So you have a number of moving pieces that to us suggest it's more likely towards the end of this year than sooner when you start to see all of these pieces line up and just a better, more stable footprint from DocuSign going forward.
What is, in your estimation, what does fundamental demand look like for DocuSign services?
I mean, it's still healthy, right? I mean, we all still have use cases that we think about where there could be digitization and it hasn't happened. You think about some of the more traditional industries, public sector, other areas, they're still far behind. So DocuSign's still adding customers. If you want to take a more optimistic view, they're still adding 30,000 customers, even over 1 million customers in an environment like this. They're still showing some degree of expansion, although much more modest than we've seen historically at 107% expansion rates. So I think there's still ongoing demand. It's just the pace of that is challenged right now. And intuitively, you can kind of see it, right? If you think about sales activity or employee activity or mortgage activity, some of the use cases that DocuSign is tied to, all of those are not in the same positive state that they were 18 months ago. So there's a scenario where these things start to move in a more favorable direction for DocuSign. But right now, it's just not the case. And so I don't think this is as much a demand issue as how much can you capture and just what's ahead in an environment like this that's challenging them.
And speaking of challenges, I mean, as we go through this year and the Fed is expected to continue tightening, what is that going to do to companies like DocuSign?
Well, I mean, the negative case would be this starts to put companies out of business. And if companies go out of business, then that's going to hit someone with as far-reaching a customer base as DocuSign. The positive case would be this is a quick ROI efficiency-based play. We all know that overnighting things via FedEx to make sure that they're signed and back to you is a much more costly endeavor. So, there is a world where I think DocuSign can find some ability to still sell their products, but certainly not at the elevated growth rates that we saw, right? This was a business that was growing around 30% pre-pandemic. Those growth numbers hit 50, 60% on the back of COVID. And as you get to bigger numbers, the growth rates naturally decelerate. So now we're talking about 14% growth in the current quarter and shades below 10% for the coming year as what's currently forecast.
You know, Michael, that's part of the reason we actually wanted to talk to you today, not just DocuSign's earnings, but we're coming up on, amazingly, the 3-year anniversary of the pandemic shutdown, right? And this is one of the companies that was sort of emblematic of that period of time and the elevated growth rates that you're talking about. You cover a lot of other ones. Zoom, I see, is on your coverage list, for example, as well. So you cover a lot of these pandemic darlings. Is there one, and so many of them have now come down and have been struggling, et cetera, in the wake of that, and tried to get back to normalization. Are there one or two that stand out as having really done a good job of managing that transition?
Well, the more mature companies are doing the better job, right? So this is where you can look at a contrast to someone like Salesforce, and you can argue that there are a lot of forces pushing them in a different direction. But I think the reaction for DocuSign stock here would be quite different if they were pushing margin more aggressively. This, you could argue, is one of the more efficient businesses in software. Its margin structure could be potentially Adobe or Salesforce-like. Again, the challenge a lot of these businesses are facing is that it's the same management team that was prioritizing growth coming into the pandemic and at a much smaller scale is now being asked to manage an employee base that's 2 times the size of what it previously was and get to a true operational framework that most of them haven't had to see yet. So the bigger, more mature companies that have seen cycles are the ones that are navigating this more effectively. If someone like Salesforce is effectively pushing their margin from 20 to 30% very quickly, and that is a very comfortable offset for investors if top line growth is slowing. So those that are able to kind of lean into the bottom line with a little bit more strength are those that are getting a little bit more credit in the market currently. And there's just a younger generation of companies where this is kind of the first real macro challenge that they've seen, and generally that takes time to calibrate around and often a shift in the management team.